Hello everybody, welcome back to the weekly portfolio review series. This is a series where I go over portfolios from my subscribers, friends in the investing community, and more. The main objective of this series is really to not only promote transparency, something that's really lacking in the finance community today, especially with a lot of big channels, but also get exposure to new stocks, investing strategies, and so much more. And once again, if you want to be featured on this series, please message me on Discord or you can email me. I go over the investor strategy, all of their holdings, and I share my honest, unfiltered thoughts. If there's a stock I don't like, I will share it. If there's a stock I really like, I will let you know. So today I'll be going over one of my subscribers' pcgumbits portfolio, and from first glance, it's pretty impressive. And make sure you check out the Dividend Stocks Not Drugs merchandise, the best looking merchandise for any dividend investor. Thank you, and let's get on to the video.
Hello, I like money.
Alright, so he shares that he's 18 years old and his investing goal is long-term dividend growth investing, which is a very similar strategy to currently what I'm doing. Long-term dividend growth focused investing and total returns are two of the things that kind of mix together. When you invest in really good businesses, not only are you going to get a really good total return at the end of the day, but the dividend snowball effect can really kick in over a long-term time horizon, especially if you're 18 or under. Your yield on cost will be insane, your total returns will be really nice, and you're going to have a lot of money in your pocket and more wealth than if you were to just do dividend yield investing and invest in 5, 6, 7% yielders that are going to depreciate over time if the business isn't good. Currently, his portfolio is worth £3,394, which is $4,300 in US currency. So first of all, props to him for starting investing. I have gone over portfolios that are $500 on this channel, and I've gone over portfolios that are $2.5 million. I do not discriminate. Just continue making those small investments and really investing what you can. Try and be more frugal. Do Dividend Stocks Not Drugs on Saturday, 8 p.m. Eastern on the Cashflow Kings live stream. Don't blow your money on chicks and you'll be good. But to start off, his largest holding, which is 15% of his portfolio, is the ETF DGROW. This is a dividend growth focused ETF with a current dividend yield of 1.68%. I think it's solid if you're looking for decent total returns at the end of the day, but me personally, I'd just rather buy SPY. Also, the expense ratio is about 0.27%, which is a little high for me. SHD is way less than that. SHD's actual dividend growth has actually been historically better too, and the yield, but this is on a shorter term time horizon. For me to make a better statement, give me 10, 20, 30 years, a way much longer term time horizon. But of course, performance wise, and this could be a little biased since everything is ramped up over the last couple of months, SCHD is lagging both the S&P 500 and DGROW. But just a few months ago, the SHD was outperforming, so it really is kind of one of those things that you need to research, and it's really a month-by-month thing when it comes to performance and talking about that. I'm actually considering making a video based on SCHD and some of the disrespect that's been coming its way recently. Next, his second largest holding is Visa, stock ticker V. You guys would already know on this channel, I think I am one of the biggest Visa bulls in the entire world. That's one of my core holdings personally. It's such an easy business to understand. It's a middleman business, a toll booth business, a third-party business, whatever you guys want to call it. But basically, Visa is a payment processing network. They do not get money off of credit card fees, believe it or not. Essentially, every time somebody makes a transaction through Visa's very big network, they'll basically take a portion of that transaction. They have huge pricing power in their business model. They also have insane dividend growth and have been growing their earnings so well that it's cheaper today at $280 according to their earnings than it was at $205 just a few years ago. That's how efficiently that they've run their business and grown their cash flows. Visa for me is a forever business, and I love Visa so much as a company. If you thought it couldn't get any better, his next largest holding is Starbucks, stock ticker SBUX, which once again makes up 10% of the portfolio. Starbucks I've talked about so much on this channel, and I have an entire playlist dedicated to one of my favorite companies, both personally and as a business. Starbucks is such a strong brand though at the end of the day. They have pricing power, insane growth potential in China, and once again, if you want to hear me ramble for about 3.5 hours of why I love Starbucks stock so much, go check out that playlist. The next holding is equally as strong as a company, probably stronger, which is of course Costco, stock ticker COST. Once again, truthfully, the only bad thing about Costco stock appears to be its valuation. You can never get Costco stock at a 52-week low, it seems. I remember when I started my Costco position this spring, it was trading at $530, and I thought it was overpriced then. Now, it's trading near $750. Absolutely insane stuff from Costco. One of the best businesses in the entire world. I would say the only thing bad about it is the valuation, really. I would do some unspeakable things for a Costco dip, but I don't think it's going to happen anytime soon. If it were to go on like a 5 or 10% dip, something very tiny to what it's been doing recently on price action, I would love to buy more Costco and add to my portfolio and make it a core holding one day maybe. The next company is a company that's a core holding in my portfolio at the moment as well, which is of course the Las Vegas based REIT. I am the cult leader, you could call it, which is Vici, stock ticker VICI. If you guys are on the Discord, you know that we have a Vici cult, and it appears whenever one person buys the share of Vici, 5 or 6 others will. It's a bit of a running joke, but in all seriousness, Vici is a very strong business, especially for a REIT that offers really quality dividend yield, and it's also one of the rare instances where a REIT can offer really solid growth potential as well. They're locked into long-term leases, it's a strong business, Vegas is not going anywhere, and of course they're diversifying it. So I think Vici is one of the strongest REITs right now to invest in. The next company is APD, which is Air Products and Chemicals. Air Products and Chemicals has recently had a really big dip, and it appears that their free cash flows have sunken. Now, as an investor that has had companies that in 1 year that have had their free cash flow pretty much go negative, I'm very curious to see why. I don't really cover this company really in depth, but I'm sure somebody can correct me in the comments section. Me personally, though, I don't know enough about APD to make a proper statement on it. The next company, though, I do know a lot about, and it's AbbVie, stock ticker ABBV, the pharma giant, which makes up 8% of his portfolio. AbbVie is one of those companies that is really, really hard to understand as a business, as all pharma is. But cash flows and really strong management and execution does not lie, and it's been one of my best performing stocks on my portfolio. It's a relatively bigger size position too. AbbVie offers quality dividend growth and a really strong starting dividend yield. The stock is trading at 52-week highs and has been very strong. My only issue with AbbVie is circle of competency. It's a really hard business to understand, but once again, cash flows don't lie. The next company is one that's been in the news recently, which is Texas Roadhouse, stock ticker TXRH, and they've been in the news for good reasons. They recently reported an awesome earnings report, and they've actually consistently outperformed the S&P 500 as of late. It's crazy what a simple business model and a strong brand can do. Unfortunately, I only own 2 shares of Texas Roadhouse. I really regret not loading up on that whole Ozempic craze a few months ago in the $90 range. It's unfortunate, but I'm happy that my Texas Roadhouse position is now at about $300 for the 2 shares that I've bought. It's a position I'd love to add to, but it has to be at a fair price for me. The next company is Procter & Gamble, stock ticker PG, and this is the first company that I'm not on board with. It's a long-term dividend growth holding. Procter & Gamble's a strong business, don't get me wrong. It's a defensive company, it's not going anywhere. But I think there's a lot better growth options long term, and it's on a smaller position in your portfolio. I'd like to hear your thesis on this one. The next company is one that has no issues with growth recently, which is Lowe's, stock ticker LOW. I recently made a video on Home Depot stock, and I shared why I prefer Home Depot over Lowe's. It's just basically free cash flow consistency. Lowe's has had 2 really good years of free cash flow, but I question how sustainable it will be, whereas Home Depot has more slower grown their free cash flow, but have done it at a way more consistent rate. And it's not like it's bad growth whatsoever. It's really, really strong growth still from Home Depot. But Lowe's has had 2 really quality years, and I question how sustainable that will be. And I hate buying at the top. Next, owns VHYL, which is a British ETF, which basically focuses on dividend yield. From first glance, it looks like a British ETF of SCHD, essentially. Me personally, I don't love this one, but I haven't really seen it a lot, and I can't make a crazy statement on it. But from first glance, it just looks like a British ETF of SCHD. So I don't love this holding. I'd rather have you just go into SCHD itself, but I'm sure he has his own thesis on it, and that could be corrected. And lastly, he owns Waste Management, stock ticker WM, which is again trading at all-time highs. Waste Management is a trash company, and trash is never going anywhere. Look over in the UK, they have dividend talks. Waste Management's a really strong business that offers really quality and sustainable growth. The only issue I have with Waste Management right now is trading and buying at all-time highs and the kind of premium they're currently trading at. I'm just not buying a trash company that has limited growth ahead of it like that when it's trading at the same multiples as a company like Visa. I'll think I'll hold off until it hits 160, 170, and I'll buy more. Alright, to share my final thoughts and recap, I think it's a really, really strong portfolio. My only issue potentially could be that one British ETF you have, Procter & Gamble, and maybe find more clarity in that DGRO position. Me personally, I prefer SHD, but I think DGRO will be very solid. But overall, it's a really, really good portfolio. If I had to rank it, I'd probably give it a 9 out of 10. It's really solid. Honestly, there's not a whole lot of fluff. It's really lean at the end of the day. A bunch of really strong businesses. Alright, thank you for submitting your portfolio. It was honestly one of the more pleasurable ones I got to look at. Thank you very much, and once again, if you want to submit your portfolio, join the Discord, link in the description, and message me from there. Thank you guys so much for watching. Check out the Do Dividend Stocks Not Drugs merchandise if you haven't already. It's an amazing way to support the channel, as well as channel memberships, which I've been growing recently and putting a lot of time and effort into. So if that interests you guys, look below in the description box and you will see the join button there. Alright, thank you guys for watching. Smash the like button, subscribe, and of course, Do Dividend Stocks Not Drugs. Have a good one, everyone.